Investment facilitation is really the idea of using donor support, and by donors we mean players like USAID or DFID, to provide specialized transaction assistance to specific investors, to specific companies, in order to allow them to make developmentally beneficial investments. As we first set out on this in 2011, we really had four core ideas behind it. The first idea is that we wanted to start from the bottom up. We wanted to start with the entrepreneurs and the investors and their problems, as opposed to coming in from the top down from a big macro perspective. The second idea was that primary challenge was not necessarily the availability of funds, that there was already a lot of funds out there that had the mandate to invest in these kind of companies, whether it's in sub-Saharan Africa or Asia or elsewhere. But the problem is that there was a number of transaction costs and a lack of trust that often impeded these investments from flowing to the companies that needed most. And there was not the kind of specialized advisors, and this would be the third point, that we have in the US and Europe, the investment banks, the consultancies, the due diligence firms that help lower those barriers and help those investments successfully happen. But by bringing those through donor-supported investment facilitation approach, we could really lower those barriers and see these investments that had been stalled really to start to move forward. The fourth and final idea is that we could create a feedback loop between these transactions that were happening at the more micro level and the policy changes that might need to be made at the macro level. So we weren't going to wait for the government to be perfect, for all the rules and regulations in the country to be perfect. We'd push forward with investments where we could, but then use those to help grow a government that was more responsive to the business class, to the middle class in their country. And also then on the other side, a business class that felt like they were in a virtuous cycle with government, more willing to pay taxes in exchange for the social services that might be provided. And so those were the things that really motivated this approach to how can we unlock all of the capital that's sitting in the world, pent up, looking for good investment opportunities to the companies that desperately need it in these frontier markets. In frontier markets, we basically divide the barriers that we see into four different categories. And we further subdivide that between country level barriers and sort of firm level barriers. In terms of country level barriers, and so then the first category are the macro level constraints. And these are the obvious things that you often think about in tough places. There's poor infrastructure, there's a lack of or need to skill up the workforce, there's political uncertainty, there may be instability or security issues, and these prevent investment from happening. The second category is there's a lack of capital for the available returns in the market. So given the risk, there might not be sufficient returns available, or you might have certain sectors, for instance, rural electrification, and some things in agriculture, which simply don't necessarily yield that attractive of returns. And so you might need to think about structuring instruments or funds that can blend finance to have something suitable for that risk-return profile. The third category, and now we're getting into the firm level barriers, is the transaction costs associated with each individual investment. So to make an investment, whether it's a small one or a large one, you need to do certain levels of due diligence, you need to understand the market, you need to understand the sector, the company, you need to undertake these sort of research costs, you need to have certain expertise, you need to have the ability to commit bandwidth to it. And often those transaction costs in these smaller markets can outweigh the size of the investment opportunity. So you might have a potential investment that is $5 million, but simply to understand the market for the first time, understand the investment, could cost $500,000, $1 million. And where that might just be a small percentage of a deal in a more developed market, they're quite meaningful in these markets. The final barrier is what we call information asymmetry, which is really a complicated way of saying there's a lack of trust between the parties, because each party has information that the other does not. So investors are worried that the entrepreneur is going to potentially take advantage of them, particularly if they're investing in this country for the first time. They may be worried about the legal and contractual protections that they would have. And at the same time, an entrepreneur or a company, if they're raising capital for the first time, you might have a CEO who's thinking, I don't know if this is a fair term sheet, if this is a fair deal. And so this is where having a specialized advisor, an honest broker, can help mitigate the lack of trust between those two parties. So those are the four barriers that we see as the fundamental challenges to investing in these markets. So we've been working in investment facilitation as cross-boundary for about 7 years now, and we've been successful in unlocking over $600 million in investment. I think we're proud of that track record, and obviously it would not have been possible without the support of many partners, including organizations like USAID, and also a number of local players on the ground that we work with, whether it's local law firms or local accounting firms that are really necessary to get these investments done. And those investments have created thousands and thousands of jobs. They've created better access to basic goods and services. In some cases, they've helped bring electricity to communities for the first time. So we feel like this really has had some of the impact that we hoped it would have when we first set out on this journey.